Ladies, welcome to the lesson, Advanced Management Accounting. We are going to answer question number 1, December 2023. I hope you have the question paper with you. This question is in 3 parts, A, B, and C. Part A of this question reads, with reference strategic management accounting, evaluate 3 underpinnings of each of the following concepts. Underpinnings. 1, balance scorecard model. 2, responsibility accounting. With reference to strategic management accounting, evaluate 3 underpinnings of each of the following concepts. 1, balance scorecard model. 3, responsibility accounting. Now, candidates, the term underpinnings refers to the foundational principles, refers to the foundational concepts that support a basis for a particular system or idea. So the question can be rephrased. With reference strategic management accounting, evaluate 3 foundational principles of balance scorecard model, responsibility accounting. So what are the foundational principles of balance scorecard? Can you give it a take? What do you think? Linus, Mary, Korir? Balance scorecard model. Now let me give you a hint. A balance scorecard model, candidates, is a strategic performance management framework that goes beyond traditional financial metrics to provide a holistic view of an organization's performance. All right? So this model, that is to say, links an organization's strategic objectives to a balanced set of performance measures across 4 perspectives, which I know you are aware of. That is financial, customer, internal processes, and learning and growth. So that's the meaning of this framework, balanced scorecard model. It is, first of all, a strategic performance measurement framework or guideline that goes beyond the traditional financial metrics of performance management. So now I've reminded you the meaning of the model. Give me the foundational principles. Brandon, Alex, Anthony, underpinnings of balanced scorecard model. That is the question. You're answering questions from December 2023, question 1. Part A, balanced scorecard model. The first foundational principle, candidates, is what we call strategic alignment. Strategic alignment. Strategic alignment. The balanced scorecard is founded on the idea that financial measures alone are insufficient for evaluating organizational performance. It emphasizes the need to align financial and non-financial measures with the organization's strategic objectives to ensure that all aspects of the business contributes to the overall strategy. That's what we refer to as strategic alignment. That's why in defining balanced scorecard model, I say that it goes beyond the traditional financial metrics that we use in performance management. So that's the first foundational principle. You understand? Number two is multi-dimensional performance management. There's that aspect of multi-dimensional performance management. That is to mean that the model recognizes that organizational organizations, companies, they need to monitor performance across multiple dimensions. That's why we have the financial dimension, the customer dimension, the internal processes dimension, and growth perspectives or dimension. Multi-dimensional measurement. And that ensures a balanced view of performance. And it avoids over-reliance on a single metric, like the financial metrics. So there is this concept, this foundational principle of multi-dimensional management. Number three, cause and effect relationship. Cause and effect relationship is a key foundational principle of the balanced scorecard model. The balanced scorecard encourages organizations to identify and articulate the cause and effect relationship between different performance metrics. And the idea here is to help understand how improvements in one area can lead to improvements in other areas. And that promotes a holistic approach to performance management. That is the third underpinning of a balanced scorecard. That's Roman 1. Roman 2, there is what we call responsibility accounting. Responsibility accounting. What are the foundational principles of responsibility accounting? I'll give you an opportunity, a chance to answer that one. I'll give you a hint. Let me give you a hint again by defining responsibility accounting. Now, just from the word responsibility, candidates, a responsibility accounting is a management accounting system that focuses on assigning responsibility for specific costs and revenues to individual managers or departments within an organization. Responsibility. It is a management accounting system where managers or departments are assigned specific costs and revenues, and it aims to create a clear line of accountability and empower managers to make decisions and also to take ownership of their performance. So every manager is assigned responsibility. Every department is assigned responsibility. That's what we are referring to as responsibility accounting. And these responsibilities are in relation to revenues, specific revenues, and specific costs. So the question is, what are the foundational principles of responsibility accounting? That's the question. And I'm giving you the first chance to answer it. Let me hear from you. Mary, Linus, Zebediah, Knight, Anthony. Now that you've understood the meaning of responsibility accounting, what are the foundational principles? Now, candidates, obviously, if managers and departments are assigned specific responsibilities in relation to costs and revenues. The first principle or idea that should come to your mind is decentralization. Decentralization is the first underpinning of responsibility accounting. Decentralization. Decentralization. Is it not? This responsibility accounting, that is to say, is built on the concept of decentralization, where authority and responsibility for decision making are delegated to lower levels of management. And that empowers managers to make decisions that are closer to the point of action, which improves responsiveness, it improves efficiency, and so on. So responsibility accounting is based on the principle of decentralization. Another principle is controllability. Controllability. This is a key principle of responsibility accounting. Controllability. Managers here should only be held accountable for costs and revenues to which they are assigned. Okay? Costs and revenues which they control. And what is the importance of that concept or principle? That, candidates, helps to ensure fairness and also motivates managers to focus on areas where they can make a difference. Controllability is a key principle of responsibility accounting. Okay? Because managers are only held accountable for the revenues and costs which they control. That enhances fairness, controllability. Do you understand? The third foundational principle of responsibility accounting is performance evaluation, is in relation to performance evaluation. Performance evaluation. How is it a foundational principle? How is performance evaluation a foundational principle in responsibility accounting? It is a foundational principle, candidates, because it provides a framework for evaluating the performance of individual managers. Because we've said that in responsibility accounting, each manager or department is assigned responsibilities. And that facilitates, that enables performance evaluation, because then it's easy or possible to evaluate these managers based on their assigned responsibilities. So by comparing actual results to budgeted or standard costs, managers can identify areas for improvement and also take corrective action. Responsibility accounting. Performance evaluation is a foundational principle of responsibility accounting. So those are the three foundational principles of each balanced scorecard model and responsibility accounting. Can we proceed? Part B, carbon credits and carbon credit tax are increasingly being applied in environmental management accounting as a transparent, measurable, and result-oriented activities aimed at protecting and preventing environmental degradation by adopting environmental management strategies, policies, and compliance requirements. Carbon credit tax is aimed at enhancing compliance. All right. So carbon credit tax is levied on pollution caused by carbon emission to the environment. One of the aims of the tax is to discharge organizations from operating with excessive carbon emission and instead encourage a transition to more sustainable alternatives by detecting and preventing external costs and external costs of environmental management required With reference to the above statement, identify 3 benefits that might accrue to an organization as a result of implementation of carbon credit strategies and policies towards Roman 1, environmental detection costs, Roman 2, environmental external failure costs. Those are 3 marks each. 3 marks each. Now, candidates, carbon credits are simply, they are tradable permits or certificates representing the right to emit a specific amount of greenhouse gases. Okay? So, carbon credits are, let me take it again, tradable certificates or permits that represent the right to do what? The right to emit specific amount of greenhouse gases. And they are a key component of carbon markets, which aim to reduce greenhouse gas emissions by putting a price on carbon pollution. All right. Now, candidates, you can think of carbon credits like, let me use pollution tickets. Just imagine carbon credits to be just pollution tickets, where companies are allowed to pollute a certain amount. But if it goes beyond, if they emit beyond that amount, and that amount could be, for example, 1 metric ton of, say, carbon dioxide, okay? If that is the amount of gas that companies are required to emit, if a company goes over that 1 metric ton of carbon dioxide, then they need to buy extra tickets from someone who polluted less. You understand? So it's just like it's a way to encourage everyone to make less pollution. And that helps the environment. So that's the idea behind carbon credits. Or you can put it another way. You can think of a big jar. You can imagine a big jar. A jar. Okay? Think of it as a big jar that represents the air that we breathe. All right? And we want to keep that jar clean and healthy. But factories and cars sometimes maybe put dirty smoke into the jar. Okay, you want to make it clean, but there are cars and factories that make it dirty. All right. So now imagine we have a special stickers. You can imagine you have special stickers. You know stickers? I want you to use your imagination. Imagine now we have special things like special stickers. Okay, special stickers. All right, that we are calling carbon credits. Carbon credits. So we have a big jar that represents the air we breathe, but this air can be polluted by factories, cars, and all that. I want you to imagine that now we have stickers which represent carbon credits. Now, if a factory makes less smoke or pollutes less, or a car produces less dirty smoke, it needs to buy some of the stickers from someone else who has extra. So it is like a way of saying sorry for making the jar a bit dirty. So carbon credits candidates helps us to keep the air cleaner, because they encourage everyone to make less pollution. You understand? So carbon credits are tradable permits or certificates that represent the right to emit specific amount of greenhouse gases. That's why we have carbon markets, where we have this trade going on. Carbon credits are tradable certificates. So we have a carbon market. You understand? But that's not the question, candidates. Trying to define carbon credits in a way I think everyone can understand. That's not the question. But the question is about carbon credits. So for us to understand to answer this question, first of all, we need to have an understanding of what carbon credits are. So we've been given a case information here, which says that carbon credits and carbon credit tax are increasingly being applied in environmental management accounting as transparent, measurable, and result-oriented activities aimed at protecting and preventing environmental degradation by adopting environmental management strategies, policies, and compliance requirements. So carbon credit tax, the CCT, is aimed at enhancing compliance. CCT is levied on pollution caused by carbon emissions to the environment. One of the aims of the tax is to discharge organizations from operating with excessive carbon emissions and instead encourage a transition to more sustainable alternatives by detecting and preventing external causes of environmental management. Required. With reference to the above statement, identify 3 benefits that might accrue to a company or an organization as a result of implementation of carbon credit strategies. So you have to identify 3 advantages. This is part B. 3 benefits. Benefits that may accrue to an organization as a result of resulting implementation of carbon credits as a policies towards environmental detection. Number 1, environmental detection costs. Environmental detection costs. But first of all, what are these environmental detection costs? Environmental detection costs. What are environmental detection costs? Environmental detection costs, candidates, are the expenses incurred by an organization to assess and monitor its compliance with environmental regulations, standards, and internal policies. Detection. You understand? So the environmental detection costs are the costs, all right, or expenses that are incurred by an organization to assess and monitor its compliance with environmental regulations. Examples of such costs include environmental audits. They may include monitoring and testing. They may include what we call data collection and analysis. There are courses that are involved in gathering and analyzing environmental data. And the purpose of analyzing such and gathering such data is to track performance and identify trends. So those are examples of environmental detection course. But the question is, identify 3 benefits that might accrue to an organization as a result of implementation of carbon credits and policies towards 1, environmental detection course. What are the benefits? That is the question. Now, the first obvious benefit is that this leads to reduced monitoring and inspection costs. It leads to reduced monitoring and inspection costs, because candidates, by actively working to reduce carbon emissions, organizations may face fewer regulatory inspections. They may face fewer audits, which lowers compliance-related costs. So it leads to reduced monitoring and inspection costs. 2, early detection of issues. Leads to early detection of issues. Carbon credit strategies often necessitates a robust monitoring system, which then enables early detection of potential issues. These are potential environmental issues. And that allows for timely intervention and remediation, which prevents costly environmental damage and associated fines. So that is the second benefit in relation to environmental detection costs. 3, enhanced data management. It leads to enhanced data management. And that is made possible, candidates, because of the tracking and reporting on carbon credit emissions, which leads to improved data management practices, which also streamlines information collection and analysis processes. And that can improve overall efficiency. That can also reduce administrative costs and so on. Benefits. 1, reduce monitoring and inspection costs. 2, it leads to early detection of environmental issues. 3, we have enhanced data management. Another point we can have, we have to give 3, but the 4th one is in relation to innovation. Innovation. All right? Innovation. And let me say technology adoption. Innovation and technology adoption. How is that possible? By striving to meet carbon reduction targets may spur innovation, may spur investment in cleaner technology and environmental processes. Cleaner environmental technologies by striving to do what? To meet the carbon reduction targets, a company can think of more innovative ways or strategies. Okay? So it is through that process of trying to think on how to meet the targets that companies can develop or can come up with innovative technologies and processes, which potentially leads to cost savings in the long run. 5, improved stakeholder involvement or engagement. Okay? Or let me say relations. Improve stakeholder relations. Because candidates, by demonstrating commitment to environmental responsibility through carbon credit strategies, that can enhance reputation, that can enhance relationship with stakeholders, which reduces the need for expensive public relations efforts or even legal disputes. So these are 5 points. You have to give 3. I've given you 5. Then we have benefits in relation to environmental external failure costs. Number 2, environmental external failure costs. Environmental external failure costs. Environmental external failure costs. What are these costs? We are calling environmental external failure costs. Now, environmental external failure cost candidates are the financial consequences that organizations incur after causing environmental harm or damage. You understand? And these costs occur when pollutants or when wastes are released into the environment, which results into negative impacts on ecosystems, on human health, or even on property. Examples include costs like cleanup expenses. These are expenses related to cleaning up pollution, or even restoring damaged habitats, or rehabilitating contaminated sites. Another example of this cost is compensation and legal costs. These are payments to individuals or even communities affected by environmental pollution, as well as legal fees and fines associated with environmental non-compliance. Another obvious example here is reputation damage and lost business. The financial impact of tarnished reputation candidates due to environmental incidents can lead to lost sales, can lead to decreased market share, can lead to difficulties in attracting investors. There are even employees who will shy away from working for such organizations. So do you understand? That's the meaning of environmental external failure costs. So what are the benefits? Benefits. Candidates, we are discussing benefits. We read here, with reference to the above statement, identify 3 benefits that might accrue to an organization as a result of implementation of carbon credit strategies towards environmental external failure costs. What benefits would accrue to a company that implements carbon credit strategies and policies? Okay? Towards environmental external failure costs, which I have explained. Candidates, are you following the discussion? A company that implements carbon credit strategies has the benefit of protecting its brand. One, protection of brand reputation. Protection of brand reputation. Protection of brand reputation. The reputation of the company, the brand. Because there's a proactive approach to environmental management through carbon credits. The initiatives related to carbon credits can protect and enhance an organization's brand and reputation, which then avoids costly damage control in the event of environmental incidents. What else? Correct? It minimizes candidates' environmental damages and fines. Minimized environmental damages and fines. All right? By proactively reducing carbon emissions, proactively. And carbon emissions can be reduced proactively by a company implementing carbon credit strategies. That can minimize the risk of environmental damage and even the associated cleanup costs, fines, legal liabilities, and so on. 3, reduced compensation. There's a benefit associated with compensation, reduced compensation and remediation costs. By implementing carbon credit strategies, a company can reduce these costs. Implementing carbon credit strategies can help prevent environmental incidents that might require compensation or remediation efforts for affected communities or even ecosystems. Then there is a benefit in relation to relations with the community. Leads to improved community relations. Improved community relations. Demonstrating a commitment to sustainability and carbon credit reduction can foster positive relations with the local community, which can potentially reduce opposition to future projects and even minimizing the need for community engagement and outreach efforts, because the community already knows the company is committed to reduction of carbon or pollution of the environment. So these are 4 benefits. Another obvious benefit is in relation to the market. It leads to increased market access. Increased market access. Increased market access. All right? Some markets and even customers favor environmentally responsible businesses. And implementing carbon credit strategies that can open up new market opportunities and even command what we call premium pricing. So that's all for that part of the question.